This is the Self Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Myers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self Storage Podcast. I'm your host, Scott Myers, and this week's guest is Brandon Grebe. Brandon is the principal partner for GYS Development, which specializes in self-storage acquisitions and development. And in the development world, Brandon often finds himself competing against retailers for desirable building sites. Fortunately, his superpower is getting the most challenging projects approved because he specializes in navigating the local politics and creating partnerships in the local community and involving them in his projects. And in the last 6 years, he has been rewarded for doing so by leading the development and acquisition of more than 45 sites in 13 states, making GYS one of the most active developers in the industry. Brandon and I have shared roughly the same trajectory, and our businesses are about the same size. So I thought you would all benefit by hearing from another industry veteran that refuses to slow down. So without further ado, please enjoy my conversation with Brandon Grebe. Hey, Brandon, good to see you again. Welcome to the show.
Hey, thanks, Scott. Good to see you too. Appreciate you inviting me on.
Absolutely. Well, per our last conversation, I thought that, some folks out there wanted to learn a little bit more about what you're doing, from, again, another practitioner that's in the industry right now that is growing and doing some big things. So, give everybody a little intro and a brief bio on you and your company. But if you would, why don't you fill in the gaps and tell us a little bit more about yourself and how you got started in the industry?
Yeah, happy to. So I'll try and kind of break it down because we have a few different operating businesses. So our primary company is GYS Development. And so we go out and we develop and acquire self-storage assets for the vast majority. We also do some Premier Flex warehouse product that we can kind of get into because we found some similarities between that and self-storage. But by far, bread and butter is self-storage properties. We're up to about 45 properties, I think in about 14 states, based out of Colorado, but do work everywhere. We're as far as West Coast as Arizona, and then kind of going east of that all the way to East Coast now, Florida and Carolinas. So the markets we're not in is Northeast and kind of West Coast, but everywhere else we look for opportunities. So I got into self-storage specifically about 6 years ago. Before that, I worked at a private family real estate investment office and did a ton of commercial type of industrial product. And so to kind of answer your question, how I got into storage is going through and getting my executive MBA program and studying self-storage as just kind of a passive investment from the sidelines. Knew generally about it, but not a lot of specifics. So dug in and decided to do my first real estate development project. I partnered with a gentleman that I knew kind of through acquaintance on our first one. And now that is my business partner of 6 years and really a great friend and peer that we've been doing business ever since then and hit the ground running. But our first deal, we had to put everything together. It was our first one. So our partnership agreements, the earnest money, just getting the debt and equity and getting all of that going for the first one, as you know, or anyone else who's done the first one is challenging, but that was a successful endeavor. So we repeated that and then really have been repeating that process ever since. And, and every year kind of grow our business, the amount of activity we do. So that's GYS Development. Early on, when we got started, myself and my partner, we were probably into our third deal. And I have a background in project management, construction management. And so we went to contractors, general contractors, and said, hey, we have all these great ambitions of projects. Can you kind of be our preferred general contractor? If you give us a lower fee, we'll give you all of our work, share resources. We need budgets, schedules, et cetera. And, we're two guys who don't have a big track record together. My partner's been in self-storage a long time and really on the operations side. I've been in real estate development for a long time, but together, we're kind of a new endeavor. So general contractors really weren't giving us much attention. So we said, hey, we'll just start our own general contracting company to self-serve us starting out. And so that's what we did. We found another gentleman that we knew who was looking to kind of make a change, work for a big general contractor. And the three of us started a general contracting firm. So that was about 5 years ago. Now, since then, that has taken on a life of its own, still builds for ourselves, but now does majority of third-party client work as a general contractor. again, heavy in self-storage. That's kind of our history, but moving into other assets class as well. So that's kind of how I got started. It was really on the development side. And it's amazing. 6 years is not that long ago, but the technological advances of how we even did our my first feasibility study. I mean, I had Google Earth up, I had the assessor's page up, I had spreadsheets up, and I was trying to measure the rooftops and trying to get square footages of them, and then trying to drive by if it was local, if it was climate controlled, trying to come up with these square foot per capita and other demographics. And now there's a slew of software companies that type in an address, you can get all that. So it's been fun. I mean, seeing how the industry's changed and as it kind of grown up with more institutional players coming in and year out. And we can kind of talk about that. One of the exciting things we did first of last year, so January 2021, is did a joint venture agreement with one of the publicly traded self-storage REITs called NSA, National Storage Affiliates. And that's allowed us to continue our growth in a meaningful way, a capital partner. And that alone could be a story itself of the work into it and the partnerships. But it's been a fun ride, obviously. We're in some unique times, challenging times, some would say, but not to say that there's not opportunities out there and will continue to be just as the landscape changes. So I can kind of pause there and we can, if you have questions or, happy to kind of dig in more, but that's kind of the 30,000 square foot view of where I came from and kind of the company setup.
Well, as we discussed before, our trajectory has been very, very similar in terms of our growth and the size of our companies, although started differently. I came from the existing side, actually from houses and apartments, and then buying existing facilities, whereas yours was a development. But yeah, absolutely. The speed at which we've been able to transact on all fronts, acquisition and development, with the onset of technology and what's at our disposal now. Funny story you mentioned, going onto Google Earth, we had some folks that we were sharing, that secret with 10 years ago about how you can go onto Google Earth Pro and measure the rooftops, and it gives you your square footage. And they begin using that only to find out that in one of their projects that they failed to go down to street level to recognize that it was a 3-story building and instead of a single-story building. And so they, on a couple of these, they missed it by, triple, at least for that size of a building in terms of a square footage. And so thankful for absolutely the folks, the companies, and the tools that are at our disposal now that we can put together really, the same guts of a feasibility study that we would pay a consultant to do. And not that we still don't, because in many cases we have to. We like to have that for our lenders and for private equity partners to see that third-party assurance. But many times we're using the tools at our disposal to go back in and really tweak those and take our findings back to the consultant to say, hey, I think you missed something here, or, I think we need to adjust this here, which makes us all better regardless, to be able to dial that in. So I agree 100% that we are in a much better place than we were before.
Yeah, we kind of do something very similar too. So basically do our own feasibility studies on projects, and acquisitions are a little bit more straightforward. Development is a little bit more of a art that, and a science. But so same thing. So our approach is we do our own study. I mean, we go in, understand the market, and then if we like it, that's when we'll engage a third-party feasibility company. And just like you said, so we can talk more kind of about lenders and capital and how that's evolving, because so our lenders still require a feasibility study. I mean, they, we have great relationships, but they still just want to check that box. So what we do is we do our own, and then we get a feasibility company to do theirs, and we don't provide them any of our data. I mean, we don't want them to be just confirmation bias. We want them to do their own. And if it comes back in line, that's great. That means we're on the same page. And a lot of time, generally it will be, but then there'll be data points where it's off. And then it's a good dialogue of, well, here's the data we have, here's the data they have. Because I mean, we're still signing personal guarantees on these, on the debt. So we want to ensure the projects we're doing are strong financially. So yeah, I mean, we're using software, and sometimes the feasibility companies are using the same software. You can tell by the data they're getting, but no doubt the technology side of researching markets has never been better. And I'm a huge component of sharing that data, whether it's with other developers, owners, operators, because I think one of the Achilles heel to self-storage is just the amount of inventory coming online in the same amount in the same period. We don't want it to happen to us. We don't want to come into a market where we're second or don't want to be third. So we're all about, if we're not first in, to remove ourselves. And we've done that. I mean, if some other group has just beat us into a market or ahead of us, once we find that out, we'll actually back out, because we try to take the emotion as much as possible out of doing deals. And that self-storage is a big risk as you open up with 100,000 square foot vacant property. If you're competing with 2 or 3 or 5 of those others, that market dynamic is really bad for everyone involved. So, I mean, we're uber sensitive to that kind of metric as we're going in and looking for new developments. Now, like I mentioned, acquisition is a little different. If you already have customers, we look at it a little bit differently, but still just trying to pay attention to that, and using the data that's out there now is pretty phenomenal.
Yeah, development is not for the faint of heart. There's enough risk in development, period, let alone layer on top of that the lease up risk in a market that if you're not first, or if you're not paying attention to permits to see who's coming in, on the front end of your project, then you've got two huge risk factors at play in this project. And then it's development risk and the cost, and going over budget, but then the lease up risk as well. And the banks don't like either of those. So yeah, we absolutely are keeping an eye on the market heading into it, and rely on those data sources. Speaking of development, your background in industrial space and some flex space before you got into self-storage, and you mentioned that you're still doing some of those types of projects. I'm curious, my background, even before self-storage started, very similar, but just with one building. It was a 200,000 square foot building. It was an old A&P grocery store, a rail depot. It was along the rail lines here in Indianapolis. And it had been converted over the years to an incubator. So it had small offices in it. It had 2 large warehouses. One was refrigerated, one was not. When we bought it, we converted the second floor. It was 38,000 square feet, almost 40,000 square feet, into self-storage. And so that in itself was self-storage. And then below at dock level were a lot of small businesses. They were more like a flex space. So they had small warehouse, small office in front, and then they backed up to a dock. So I got a lesson in commercial real estate just with this one property and this one project. What that did for me is it opened my eyes to, once again, being flexible and open to bringing to market what the market needs the most and being able to pivot. And then looking at where we're involved in an airplane hangar project, which is about to come out of the ground at FNL Airport near you in Colorado, in Loveland. Yep. And never would have looked at or thought I'd be getting involved in building airplane hangars, but it's storage for airplanes. So there's similarities, but getting the right consultants into that project has made that one go much more smoother than we had expected. But then also a development project where we thought was going to be a slam dunk, and in another city that I won't name, was very difficult because the city didn't like self-storage. And so when we bought this industrial building, we assumed that it was going to be approved, and it was not. And so we had to step back and rely on the experience that I had in the incubator. And so we agreed to have an incubator type small offices, co-working space on ground level. And then the other 3 stories were storage, and they allowed that. But that only happened because we were able to be creative, but then also having that experience level. So I say all that, Brandon, to just ask the question. Tell me, your industrial and your flex space background, how did that help you in self-storage, or I guess investing in general, as you kind of weave the two in together? And are you doing any projects right now similar to that, where the self-storage is maybe the anchor or a portion of the project overall, but perhaps you're converting some of the other space to some flex space or some man caves or different types, either of storage or office or anything else? Are there any projects that you're looking at right now or have done in the past that is seeing the blending of different asset classes in addition to self-storage?
Yeah, absolutely. I'll try and kind of hit on, I think, a couple of those type of questions, because they're all great. So yeah, I mean, generally speaking, so my background in just commercial development before, and a lot commercial and industrial, I think plays a part in storage, because, and as you know, and other developers out there in the world, developing real estate is a process, no matter whether it's a hangar, industrial, apartments, storage, or other. And it's really managing that process with the proper consultants, as you mentioned, like your hangar space, getting the experts in. So you're not necessarily going in blind. I mean, and I'm a huge component of professional consultants. I mean, we show up to any meeting for any asset class with our professional team, architect, engineer, specialty consultants, environmental, real estate attorney, whoever it may be, for the asset class, because I think that's how you have to represent these days to municipalities. But then, so it's managing the process, and then really analyzing the risk associated with it. So, and like storage, one of the risks is that you open with, there's no pre-leasing. You can tell someone's not in storage when they ask, well, how are we going to pre-lease? That's a multifamily guy asking, because no one
Right.
calls ahead asking for storage. You open a 100,000 square foot vacant building,
Hmm.
managing the risk. But so what I did before was very similar, and and industrial to a degree, but that was larger industrial. How's that transition though? So storage is evaluating markets, understanding risks associated with it, and then really understanding kind of the pro forma, the guts, the metrics of current day numbers and where you think you're going to be when a development opens in 1, 2, 3, even 4 years, depending on the process. So by doing that on a repeat basis, we've been able to identify some opportunities now in this more flex warehouse space, to kind of get to your question. So we are doing a handful of those a year. So we started last year. We acquired 3 existing flex warehouse business parks. And to us, it's a very similar, even financial profile, and also therefore the risk return profile of storage, meaning they have 20 to 40, maybe to 60 units or bays that are 1,000 to 2,000, 3,000 square feet of kind of the contractor type of customer base. But for us, we're very comfortable with, being in storage, short-term leases, right? Storage is the most notorious. You have monthly leases, and some people think that's a liability. As you know, and you get into it, there's a healthy churn you want from customer base. And as we saw in the pandemic, whether you have a corporate lease or apartment lease, those can quickly kind of be eroded now through different, whether it's policies or just customer base saying they're not paying. So we're not hesitant at all with short-term leases. And so we're comfortable in this flex warehouse space because it's short-term leases. Some of them are month to month, but even yearly leases or 1 or 2 year leases, we're definitely comfortable with other operators or users aren't. They like the standard industrial, 5, 10, 15 year lease, even just extended options, where we're okay still being very ingrained in the operations. So really like that asset class. It's definitely kind of supports the working class of contractors. It seems to be our customer base. A lot of small businesses, owner operators type of users. So just very familiar with that. I think there's opportunity there. So we're developing our first one in locally here where I am, and not too far from the airport, just in northern Colorado. And the generic term you might say is a man cave. But this is going to be a for sale product. So the development and the program looks the same. We're building 1,000, 3,000 square foot bays or units. There's about 60 of them, and it's in a business park. But then you kind of get into these nuances or strategies. So we're selling these. We're doing a condo map over the project, and we're selling these on an individual basis. So an individual or a business owner or both can own it and operate out of there. They can operate a small business. They can do retail out of there. It can be a small gym, but also can be executive storage, toy hobby type of space. And so really we're using our same team that we work on storage developments on this. We're called, Flex Warehouse. And our brand is called Premier Flex. That's just what we've termed it, but there's others out there. So we're using our same team and our same process. It just kind of 1 degree difference in storage because we're familiar enough with it, but also see opportunity to kind of get into that market. And so that'll be exciting. And we're definitely looking for more this year and years going forward.
One of our development partners in a project up in Minneapolis, we built out a Class A 3-story self-storage facility, but it was built so that it could be converted back to any type, was not back to, but it could be converted into an industrial building of basically any sort, depending upon who wants to go in there. The multi-user can go in there. It could be a single user, just the placement of the elevators, the stairs, the construction type windows, everything that we built into the design of this. It's built for self-storage, but it could be converted. It seems to me, and we've been through this, we saw a little bit of this back in 2008, 2009. There's a whole lot of folks that came to that large industrial building that we had in the last recession where businesses were downsizing and folks were out of work. And so the entrepreneurs or a business that, now they were half the size they used to be or a third of the size that they used to be, and they were vacating their old leases or selling buildings, and they wanted these 5, 7, 10, 12,000 square foot spaces. The entrepreneur that's coming out of the garage or the basement, they want 1,000 square feet, or these flex office spaces. Are we seeing? I believe that we're going to see that again as we head into this next recession. But do you think, Brandon, that some of the new construction, that it's going to be built in a way that it's going to be more flexible to be able to accommodate, to have movable walls, or walls that are so easily taken out, where you can adjust the spaces and the HVAC that can then accommodate and go from space to space, so that you can essentially contract and expand under one roof to accommodate the needs of the economic cycle and what's happening at the time? Does that question make sense?
It totally does, and it's a fascinating topic because I mean that's kind of a theme people have talked about. Or so I mean, storage used to be kind of a land play, Gen 1 storage would kind of be put it out there and you wait for some land appreciation. That's obviously changed where I mean we're building and buying a new development. $10 million is not a unknown number. Today's world, plus you get in the market. So they're really focused asset classes. We experimented on one of our projects with exact kind of what you're mentioning of, do we design and build it in a way that it could be converted? And not to get into the minutia of it, but as the majority of storage, multi-story properties, projects and buildings, the structural load is carried each floor down just by the unit configuration itself. So there's, in contrast to conventional multi-story buildings that have columns and beams spread out, storage is a bunch of tiny toothpicks holding up each floor, structurally integrity, things like that. So traditional storage is on a multi-level nearly impossible, or cost prohibitive, I would say, to convert it after the fact. So it sounds like you explored it. And so we looked at one project. Do we build it on kind of column and beams where someone or us could come in the future, gut it, and convert the use? The challenge we found was, in today's environment, you kind of hit on it, like, to budget a development project is more challenging now than ever because of all the uncertainty and I'd say price escalations. We are really yet to see anything going down. It's just a question of how much things go up. And in developments, I mean, it'll take us, on a very efficient process, it'll take us a year to develop. But more than likely, that's 16, 18, 24 plus months to develop. And then call it a year to build. So our development yields are getting less and less than they were a few years ago. I mean, 6 years ago. And it's funny, I talk to people who are like, oh yeah, I'm building it. I did one 2 years ago, and I'm going to start another one. I'm going to build it for X dollars per square foot. And if you're not actively in touch with where pricing is, people get sticker shock all the time. I mean, I had a guy who swore he was going to develop his for $65 a foot again, because that's what he did 2.5 years ago. And I didn't necessarily want to burst his bubble, but like, that's going to get you maybe 2/3 of your project. I mean, pricing has just gone up. So I saw that we had a really tough time penciling the current self-storage business pro forma, because what we found is, to build it where it has future flexibility, there was quite a bit of incremental costs. And so our storage pro forma, and we work with private capital and conventional lenders, our storage pro forma was having a hard time absorbing those front end costs for a future potential conversion. So we experimented with one. We're not doing it anymore. If we're dedicated to storage, we're doing it in that 3-story fashion. But I mean, I love the idea and continue to kind of chew on that. I mean, one thing I will say is, we acquired a few conversions, and I know you mentioned when we talked last time you did too, where I think that lends itself to better future proofing with other space. Of either you just have room in your building you can reconfigure, or obviously a single floor is much different. If you need to wipe out 10,000 square feet of storage to convert to some other light industrial user, that's much more manageable. So I definitely see that happening going forward.
Well, it's already pull and beam, and you're getting it for maybe not pennies on the dollar, but certainly at a lower cost per square foot than building new. And so that's why it makes it that way. And so, we're just looking at things in a little different light. Out of necessity, one of our projects, we had to bring in office something else before the city would allow it. And we're seeing that, several of our other developer friends are doing the same thing, whereas a building won't work or a building is not going to be permitted as a use for storage 100% in this downtown area. But if they put retail on the floor level or some office or a combination of those, but then they can put storage, on the stories above. And that's what we've been looking at as well. And so I think we're going to see more of that, both out of necessity, but also, as our economy changes. I think we're going to see some more blending of storage, and hopefully those projects will work. One of the other things I want to touch on that you mentioned, Brandon, is how do you position yourself, to work with an NSA, to work with some of the larger REITs or even the smaller REITs. I know you have to be, 100% storage, and they want clear focus. There's certain things that they want. Tell us a little bit about that journey into that partnership. I've known some folks that work specifically with a NSA that have partnered with them and that have sold to them, and they kind of go, they've gone in lockstep from the beginning to, define what the relationship's going to look like and what an exit strategy is, and other folks that have just plain sold to them as buyers in the past. But it sounds like you're it's more of a partnership and in lockstep. So tell us a little bit about that journey and how that came about and what the relationship might look like if somebody is looking to find somebody to come along with them.
Yeah, happy to kind of share our story. It's somewhat unique, but again, back to like these trends or managing the process, because no doubt other groups, if are interested or can kind of probably find something similar enough to it. So for us, again, we started out heavy development, and then we started to acquire some existing self-storage facilities, kind of value add, low lease up deals, all working with a great private capital company that we work with, that we've had phenomenal relationships since the very first deal we've done. But all of those were with conventional debt on them. So as we went through and were accumulating these assets and our conventional debt, most of it, the vast majority of it was recourse, meaning that we're signing personal guarantees on the conventional debt. So lenders, as we come up with another project, they will start, and this will happen for anyone doing real estate, which again, real estate is a phenomenal business, but it's capital intensive. And for us, we didn't start out with a lot of capital. We were the boots on the ground. We're kind of the expertise, the grinders. But so we've raised capital and working with lenders. I love the day when that's not an issue. We'll see if that ever happens. So we would go to them with the next project, and they say, yeah, it looks good fundamentals, but they have what they call just global underwriting, a whole real estate summary of what you own and really your contingent liabilities. How much debt are you signing on? And we're getting to a point where it was kind of maxing out. I mean, lenders just have certain thresholds of what they're comfortable lending any given person based on their balance sheet and personal net worth, et cetera. So early on, we would sell an asset or two a year to the open market. And we've sold to Public Storage, those guys over there, they're great. We've sold to some other private equity groups. I know you're active in the industry and transacting, as well as others are right now. It's a very active time. So we would sell to recycle not only our capital, because again, there's a certain constraint there, but really recycle our debt and our personal guarantees. So even starting out, I mean, I'm a big believer of like start with the end in mind. Like, if you want to be somewhere in 5 years, 10 years, you understand where that is, and then you work backwards. So we always had a strategy of we wanted to do some type of roll up exit with a portfolio. Now, we didn't know what that necessarily would look like, who it would look like, what type of partnerships it would be, but we did have that in mind of let's build up this group of quality assets with kind of quality partnerships involved, and then let's figure out what we want to do with that, knowing that we're just going to kind of pay it forward with new capital and debt. So over the last couple of years, we've brought in another partner to our GYS development company who actually had a background in corporate storage America. And so brought some really good insight of some of the opportunities that we could have regarding that. And so that relationship led us to talking with NSA, is our NASDAQ stock ticker, National Storage Affiliates. And their business model is they have what they call PROs, preferred regional operators, where they have these group of owner operators around the country that have assets, and then you kind of partner with them to help their pipeline grow and to help the REIT grow. So through our partner, kind of had that relationship. So we started talking with them and what that would look like. And it fit a lot of what we were looking for, an exit partner, an ongoing partner, and then really on a go forward basis, capital for us to continue to grow. So working with such a large company, it just takes time. It was in COVID. So we started working on it actively. COVID kind of hit. We just said, "Oh, let's put on the brakes. Figure out what this world's going to look like." Re-engage. So it took almost a year to really work through our partnership agreements, and then with that, just figuring out kind of our long-term property management strategy. And so we use Argus Self Storage, which is a property management firm out there. Did a partnership with them to manage our REIT properties. So now I think we were the 10th pro to come into NSA January 1st, 2021. It's a great partnership. So we are, our flagship or brand is Blue Sky Self Storage. So that's what our pro brand is. And we go out and we acquire under that brand pro, kind of the capital stack is a partnership agreement with NSA. So they are the bank, both on the debt and equity side. Now, to do that, we had to roll in our portfolio of assets as kind of the initial contribution. So that's how it works. And there's pros and cons working with publicly traded company. I mean, we're subject to stock pricing just as everyone else is. And so, we evaluated that. But for us long term, it freed up our previous portfolio that we were looking for an exit strategy day one. In a sense, a term is called an UPREIT. So we roll our assets into the UPREIT, and then there's some stock options with that. But then really it allows us to continue to go forward and grow a portfolio with inside that REIT itself, as well as giving us the autonomy. Our development company is separate, and we can go out and take on the development risk of doing new projects and getting them built up. So I say all that, not that anyone may follow that exact path, but right now portfolios drive a premium. And there's a bunch of, so there's the 5 publicly traded REITs, there's dozens of private REITs, and then even more even just private equity. So if groups are out there, and of course they'll buy a one-off, but for us, we also wanted to stay in on the backside. So that's where REITs have that option. Some private equity groups I've heard of kind of have that option where you transact with them and you can still hang on to an extent going forward, kind of the best of both worlds, depending on what your goals are. So the funds that have come into the self-storage industry, even the last 12 months, could be a whole podcast. I mean, it's phenomenal the amount of money coming into storage. And it seems like there's a new $1 billion plus group entering monthly right now, kind of household names on just the investment side. And no doubt, they're looking to acquire self-storage assets. So if groups have them or you're able to develop them, I think that's an added value that we'll continue to see going forward.
Yeah, anytime, well, the REITs, their number one goal is to make a return to their shareholders, and they need to do it in a time frame in which they can somewhat predict. And development, there's no way you can predict anything. And so to buy a piece of dirt and expect it to open your doors in 13 months it is not there once you go through permitting and entitlement. So yeah, the merchant developers have done very well, even if they didn't plan to be merchant developers a couple, 3 years ago, are finding themselves in a position to sell because they just can't afford not to with the money that's been chasing. And we have a portfolio that literally yesterday, as this podcast airs, we just received the final offers. We put this out and had a number of folks. We had 98 parties pull down the packages. It's a 3-pack of conversions, very, very high end and very high dollar conversions. And I know who the normal cast of players are going to be whenever we sell an asset or a couple assets. And literally, I didn't know half of the folks that were on this list, Brandon, to your point. There's a whole lot of funds and private REITs that are being created that are chasing these deals. And, part of me says, geez, we should put a property out for sale at least, once every 6 months, just so we know who the players are and see
Yeah,
what
that's
things look
right.
like, because it changes. Not that we wouldn't still go through the broker network to do so when we list them, but it's just kind of curious to see what's at play, and the amount of activity and people chasing storage. But people that are chasing storage are chasing yield, and they're coming out of Wall Street as things change and interest rates go up, into cash flowing, income producing real estate, hard assets. And so the story that we have to tell right now, and the position that we're in, is a good one for those of us that are in the industry. So that being said, Brandon, give us a little insight, if you would, into what does the business model look like? What does the focus look like for you, without divulging all of your secret plans? But for the rest of 2022, where do you see the focus, and what are you maybe doubling down on?
Yeah, for sure. And first, congrats to you on that portfolio
Thank you.
transaction in the works. I mean, it it take if people aren't doing it, it takes a phenomenal amount of effort and work to get to the point where you can sell. A lot of people see the
Hmm.
transactions and that, but years and years in the making. So
Hmm.
congratulations to you and your team for doing it. It's really, that's the secret sauce. You have to be stubborn. I mean, developments are taking longer than ever. They're costing more than they ever have. And to your point, you hit on a great point. Municipalities are not opening their doors for storage. They, if anything, their design standards are getting tougher. They think if one's in the market, then why would you have another one? I mean, we've been in city council meetings. There's already one over. Like, why are you here? And even
Brandon, I literally had a city administrator tell me, he says, well, you know what? That means that people have too much stuff and they just need to sell their stuff. We're not going to allow any more. And so they want to change the consumer's habit rather than, have development of self-storage in their city.
right in a property they don't own, and I mean,
Hmm.
the zoning, you got to go through there. So
Hmm.
and you just mentioned something too. I would echo is the requirement that any developments going forward have this mixed use component. We've done one outside of Boulder, Colorado, that uh, three developments prior to that got denied because it was conventional storage, and so we worked with them and worked with them. And this takes years. It was 2 years, but we did a retail commercial space on the first floor to appease them, because some of the buzzwords are primary, they want employment, they want sales tax. Self storage truly doesn't really generate any of that. So
Correct. Yep.
uh,
That's the rub. Hmm.
that's a rub. And then there's the stigma of
Hmm.
the past look and feel and use. So
Hmm.
that's an educational standpoint. But
Hmm.
so I think that's a trend going forward. Mixed use, especially as storage continues to get urbanized. Trying to. I mean, we've competed against Walgreens. We go in by grocery stores. I mean, the look and feel is retail oriented, commercial storage facilities, and a lot of cities and want mixed use. So I think that's a trend. But as far as like what we're doing is, one, we're staying diligent, never trying to get emotional about a project. And the development costs are concerning to me because it is getting expensive. An example being, we're doing a project in Overland Park, Kansas. Well, even let me back up. I tried for 2 years on another site in Overland Park, Kansas. Went through the whole rigmarole, sat down, in front of city council, got denied after midnight after 2 years. I'm talking about just licking your wounds. But to your point, you to be a developer, you got to be hard headed, you got to be stubborn. It's not for the faint of heart. Went back, found another site in the same market that had better zoning. Got it done. But it's next to a Costco. This was last year. To get one paper signed by Costco corporate took 5.5, almost 6 months. Last year's pricing volatility, I mean, volatility just going up, it wasn't going down. It cost us almost $600,000 because we had a full price, permit ready, contractors ready. That 6 month cost us $600,000 of real money because subcontractors went away or they wanted
Yeah.
more. So real challenges we're dealing with. And so I think maybe my, not advice per se, but just forecast is that's the norm. Like, we
Yeah.
developers have to be prepared for pricing escalation, delays, things taking longer, slower. So the expectation needs to be there. However, I say that to what we were talking about earlier, the value add of getting these done has never been higher.
Yeah,
And interest rates
without a
going
doubt.
up, no doubt should play on effect in cap rates long term. We'll see how that plays out.
Yep.
But there, it still makes sense, as you kind of said, a merchant developer to do. So for us, we're staying focused, we're staying diligent. We try to do about 5 to 7 developments every 12 months. We acquire on top of that. So we like growing markets. I mean, this is not anything
Mm-hmm.
a secret, so I'm happy to share. I mean, we like growing populations. So we look at areas that are doing that, really a Sun Belt type of
Mm-hmm.
parameter. It's more the same, but being incredibly diligent, and we're saying no more than we have. I guess it's the other thing of deals that 3 years ago we did. It was kind of on the fringe, but it was still a strong enough deal. Today, we're making sure they are incredibly strong because of all the
Mm-hmm.
uncertainty I mentioned. Which
Mm-hmm.
means we say no, and
Yep.
so we have to look at more. We hired a great colleague now down in the southeast to help us look at that market a little bit more. So we're expanding our footprint and what we're looking at. But again, our target of how many deals we're going to do is the same. We just have to look at a lot more because we're saying no a lot
Mm-hmm.
more.
Mm-hmm.
So I don't know if that even answers your question or is helpful, because it's not. I mean, we're not doing anything scientific. We're showing up and grinding every day, and
Mm-hmm.
as over time that bodes well.
Well, that is the secret sauce in business. It's just persistence and building in and learning from, and just putting the best business practices in place, and then applying it with a disciplined approach. So we're taking basically the same approach. It sounds like that you are, and that we have no desire to do any more deals this year than we did last year. Some of them may be a little bit bigger, and if there's opportunities because of the nature of what we do and in the course of business that present themselves, especially on the acquisition side, then if we have the ability to take them down, we will. But from a project basis, from developments, we're going to be in that probably 6 to 8 range. You said 5 to 7, and we may fall back to that as well. And that's about all what we feel comfortable with. I don't want to grow and expand a big team, and I also don't want to put that many resources at risk in the development world when we're in an environment where interest rates are rising. So that is our approach. At least it sounds like we're on the same page with that. So as we end our time here, it's been a pleasure. I certainly would love to have you back, as we could take a deep dive on several of these other topics and areas in which you're focused in. But between now and then, if folks want to learn a little bit more about you and your company, what's the best way for them to be able to connect and find you?
Yeah, appreciate it, Scott. Would love to kind of just continue these conversations.
Mm-hmm.
By all means, it's been great. So the company GYS Development, the website's gysdev.com. Find us there. We talked about a lot of our portfolio. We do development for third-party clients, quite a
Mm-hmm.
bit actually. So if you can find us there, GYS General Contracting is our general contracting firm, and again, we're building for ourselves, third-party clients, really throughout the
Mm-hmm.
U.S. And then just a plug for the ISS show in general, the conference in Las Vegas. I'll be there as well. And actually, they asked me to speak on development pro formas kind of in this current
Mm-hmm.
turbulent, unknown time. So, invite anyone to attend the conference. It's a great group. I know you're going to be there. Love to connect. And, it's a great exposure to the industry. And if you want to get, educated on certain seminars and things, you can do that. So I'll be there as well. But yeah, I'd love to kind of continue this conversation. It was great talking with you.
Yep, you as well, Brandon. And we'll wait till after the ISS show, and then they'll allow you to probably speak on what you're going to be speaking on stage, because development pro formas right now adds a little extra wrinkle to it, as we need to predict a little bit more as to what's happening in the environment. And I'll be speaking on Wednesday as well, and talking about the great roll up of what we're seeing, and how this industry is just one of the few that is still the wild, wild west, and the last frontier that is available for roll up, unlike a multifamily and retail and hospitality. And so talk about smaller investor, how to take advantage of that, and how to position yourself to either roll up and sell off, or continue to roll up yourself and get that economies of scale. So yeah, looking forward to seeing you out there, and just connecting with everyone at the show, Brandon. So once again, thanks so much for your time, and we'll see you very soon. Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.